Is Bernie Sanders correct? Not that I agree with him often, but is he correct on this proposition that there is an oligarchy developing in the United States? Well, I want to take a look at that and explore it on this episode of The Steve Beaman Show.
In a world of uncertainty, where business, freedom, and the future hang in the balance, one voice rises with clarity, experience, wisdom, and conviction. This is The Steve Beaman Show, the voice of the independent American.
Welcome back to this episode, my friends. It's good to see you again. We've been through a tumultuous week, and I know all of you feel the same as I do about the tragedy of September 10th, the remembrance on September 11th, and the commentary going forward from that. But we'll let that be for now. I want to talk to you about something that's really close to me. I've studied economics most of my life, and we hear a lot of talk from the Bernie Sanders and AOC crowd about an oligarchy. In fact, if you've been watching me for a while, I did a podcast on billionaires, oligarchies, and hypocrites and all that stuff, because I think they are frankly out without any knowledge of what they're talking about, just complaining and ginning up a crowd to make money. But is there an oligarchy building in the United States? Is our free market capitalistic system at risk? And I think there are some answers to that might be factually true that could help you understand that maybe we are headed down a path to a concentration of wealth that unintentionally we got there without trying. And I want to look at that today. And the reason is I want you to be as educated as you can, because we're dealing in a system in our country today where financial, I'll say ignorance, but not knowing the truth behind finances can lead to problems in our political system. And I want all of you to be as educated as you possibly can. So I want to take a look. Is America still a free market system? Adam Smith promised opportunity, competition, and a reward for hard work. And in the past, we created a democratized system at the New York Stock Exchange and the NASDAQ and the other systems that would allow small companies, as they grew, to then spread the wealth, so to speak, by taking their companies public and having the public own shares in those companies. Well, in the last 40 years, what we've seen is a declining number of public companies. In fact, it's come from like 8,000 back in the 90s down to a little under 4,000 today. I mean, there used to be an index called the Wilshire 5000. You can't even run that today. And the reason for that is that it's become too expensive for small companies to even consider going public. And the regulatory state and regulatory nature of a public company, or the rules around a public company, are such that, well, people don't want to go there anymore. So they've flown into private equity. Well, that's done a couple of different things. It's, first of all, concentrated wealth in the markets themselves, because there are fewer and fewer companies driving those markets. And it's, of course, driven concentrations of wealth into private equity, which most people have no way to invest in that. So I want to continue this and help people understand that, yes, there is a problem developing in our capital markets, but it's not just because Donald Trump cut taxes to the rich. That has nothing to do with it. It's the regulatory state that has made some big mistakes. So I want to look at 4 or 5 things with you that give you meat and fact on why this may be happening in the United States. The first one, and this is the genesis of this podcast today. I was trying to think back in my life why I have seen such a transition in companies from being dividend driven and long-term driven to short-term, quarter-to-quarter driven. And there's a lot of things going on. But there was a major event I saw in 1982. And that event is much of what drove this transition from companies into long-term stewards of capital, into short-term maximizers of stock price. And that was this. There's something called the Rule 10b-18, 1982. It was an SEC rule that created a safe harbor for companies to buy back their own shares. Prior to that, when a company bought back its own shares in the market, they were under scrutiny for stock price manipulation, because if a company knows it's going to buy back its own shares, it knows those prices are going up. So there was a real risk of companies being sued for stock price manipulation. So as a result, they didn't buy back their own shares with excess capital. They paid dividends to shareholders to return the capital, or they used the money to grow the business. With that safe harbor in 1982, that dynamic changed. All of a sudden, companies were free to use their excess capital to buy back their shares, which in the near term is a much faster way to run up your stock price. Again, very simply stated, but if you make $1,000 a year and you have 1,000 shares of stock, you earned $1 a share. Well, if you go out and you buy back half of those shares, you now have $1,000 of earnings to 500 shares, so you have $2 a share. That's an immediate hit to your stock price. And so what it did is it changed the dynamic of incentive to the CEOs. Instead of being long-term driven to build value in those shares and to build dividend streams for investors, it changed to short-term stock price. That was a major, major effect in how the free markets allocated capital. But let me go down. As we went through the next years, and we started to see companies more and more doing that, you had two legislative things that came down. Sarbanes-Oxley, which was 2002 following the Enron collapse. And Sarbanes-Oxley completely burdened small enterprises with a crush of new regulations. Now, if you're a small company and you're looking to go public and you want to go fill out the Regulation A and do all the things, there's a cost to that. There's lawyers you have to get involved. There are accountants you have to get involved. What Sarbanes-Oxley did was greatly increase the cost of that bureaucracy, because not only did you need it in the filing process, but you needed it subsequently to make sure that your company's registrations within the public markets were on point and accurate. That raises the cost of a company being public. Now, again, I'm old-fashioned, but I think people respond to circumstances. So if you raise the cost of something, you get less of it. If you reduce the cost, you get more of it. What Sarbanes-Oxley did is it started to fuel more of this, well, we're not going to go public. What's our other option? And coming through the 2000 and early 2000 and 2000s period, and you may recall they call it the Great Recession of 2008, which I don't think it was that big a deal. It kind of came and went. But the point being, in 2010, you have the Dodd-Frank legislation. Now, what that did is furthered the cost. So we began shifting cost into companies that wanted to be public, and not just financial cost, but risk costs. CEOs were being held to a whole new standard, and they were becoming personally liable for the behavior of their companies. So the idea of being public really did start to say, wait a minute, I don't know that I want to play this game. Well, through this period, you have this notion of private equity, and private equity being pools of very high net worth capital that go out and acquire companies to build mini conglomerates, if you will. Well, the private equity markets began to sniff around because they're saying to the entrepreneurs who started these companies, hey, instead of going public, just sell it to us. Yeah, the market has higher multiples. They'll pay you more for that company than we will, but your regulatory headache is going to be off the charts. So what happened is you have this buying back stock issue together with Sarbanes-Oxley, together with Dodd-Frank, and then you have tax policy that changed, where it began to favor buybacks rather than dividends. Dividends, as you know, are double taxed. So when a company pays a dividend, it can't deduct it as an expense. It's a return of capital. It's a return of capital to the company's books, but to the individual, it's income. Now, go figure that. The company is returning your capital to you, but you're taxed on it. So I've invested $1,000 in this company. The company declares a dividend. It's giving me back that $1,000, but I'm paying tax on it. So tax policy favored not paying dividends. It favored a company just buying its stock back. That's a faster way to juice up the price. So you saw, again, simple incentives go a long way. When you charge people to do something, you'll get less of it. I mean, I'm going to digress a minute, but I hear all the conservatives say we don't want to raise corporate taxes because that will get us less corporate activity. And they're right. Well, now we want to put in tariffs. What the heck do you think those are? Those are taxes. We get less of it, less imports. My point being, when you change incentives, you change behavior. So you have this Rule 10b-18, you have Sarbanes-Oxley, the Dodd-Frank, you now have tax policy that favors buying back stock rather than paying dividends, and you have an antitrust drift. Because the government itself is forcing a concentration of wealth, the antitrust regulators backed off. Again, think about the U.S. Equity markets in the S&P. We went from 8,000 companies to a little under 4,000. You've concentrated the wealth. And the private equity companies have soaked up that additional wealth. So you forced wealth into fewer and fewer people. That is where you're seeing the true development of an oligarchy. It's not from Sanders and what those idiots are saying. This isn't just because we cut taxes for rich people. It has nothing to do with that. It has to do with structural impediments to companies using the public markets to democratize their stock. We've set virtually all of the policies against it. So people aren't willing to take the legal risk, the financial risk, and the other risk of going public. Instead, they just sell to private equity. That's where this is derived from it. And so what that means is you have fewer choices. You have concentration in airlines, banks, media, tech, all of it being concentrated. You have wealth concentration because, again, most of us can't invest in private equity. Those are private partnerships that you have to be accredited to get into. And the accreditation standards continue to be a barrier to entry for people. You also have this issue of political capture. And this is a bigger one. Small companies, independent companies, and I credit NFIB with being a very strong proponent legislatively for lobbying on behalf of the independents. But they don't have the kind of budgets that the big guys do. So you have a political lobbying effect in the big guys that squashes the small guys. I mean, that's always been done. It's just getting worse and worse because we're taking away the ability of the small guys to go out and play in that space. So if we look, you've got this fewer choices, this wealth concentration, and this political effect. The result, the markets are less and less free. But this isn't tax policy and like individual Elon Musk generated oligarchy. This is government enabled oligarchy. The government caused it. And you could argue and say, well, it was intended well, and it's right. But the old thing, the road to hell was paved with good intentions. Government stuff usually has good intentions. It's just the result is a disaster. This is one of them. I mean, they went to companies and they said, you can buy your own stock back without fear of, stock manipulation. It's okay. Companies should have the right to use their capital as they see fit. But unintentionally, when you tie that to tax policy on dividends, for example, and the increased regulation, you end up with companies going, you know what? I'm just going to use the money to buy back my own stock. And the small companies don't want to go public. So it has created a real concentration in this country. And to me, that's not healthy. Independent businesses, again, going back to NFIB, generally lack individual lobbyists. They can't argue for reduced cost. Now, NFIB does a good job, but the small companies have to bear the compliance cost of all these new regulations. So what happens? Again, the small guy says, I go public and I carry all this risk, or I sell off to private equity. Well, which would you do? I mean, the fact is you sell to private equity because they can't play the earnings per share games that the big guys can. They don't have the lobbyists and the lawyers and all the games you have to play to be public. But this causes America to lose opportunity and the American markets to lose competitive advantage. We still have far and away the best markets in the world. There's no question about that. They're liquid. We have strong markets. But if we keep down a path of over-regulating them and having dysfunctional tax policy, we end up with a system that won't create the dynamic free market we need for the next 50 to 100 years. Now, you tie this into the digital economy as well, and it's a call for less regulation. Let more companies access the public. Let the public be educated in what they invest in. So we end up with a market that can democratize ownership. Now, I think the blockchain will be a big part of that. I think you can do a lot with what are called DAOs, or the distributed autonomous organizations. That could become something new in the corporate space. But the goal is to, democratize the ownership of these companies so that everybody participates in the growth of an economy. You can't do that when you overtax and overregulate. So if you look at the 35 million independent businesses, they are the backbone of this country. A small percent of them will grow to the point where they can go public. But now, instead of going public, they're going to go private equity, and that means you can't participate in it. Imagine Apple Computer today. How many people have made millions of dollars on Apple Computer or Google or any of these big fancy companies, Tesla? Imagine a world where Apple, instead of going public, just got sold off to private equity. If we continue to raise the cost, both financial and risk, of these companies going public, they won't do it. And that's the cost, and that is the cause, I should say, of the oligarchy that's building. It's being created by the government. It's being created by the regulatory state, and it's being created by thoughtless tax policy. We need to put a path back to real competition in the markets. I think we need to rescind the 10b-18 rule. I think we need to disincentivize companies from buying back their own shares and incentivize them to pay dividends. Incentivize them to think longer term than the next quarter. I think that would be good for everybody. We need to rescind and reform many of these public company rules, especially for new companies that want to go public. We need to reduce the legislative cost, the risk cost, and the financial cost. We have to do that. And we have to level the tax code. We have to understand that dividends and buybacks should be treated equally. Because you can't tax this and not tax this. You're going to get more of that. One of the things that frustrates me about government is it doesn't understand people respond to incentives. When they do their budgeting, for example, and they come out with the CBO budgets, those are flatline budgets. They assume steady state behavior going forward on tax cuts or tax increases. Well, the fact is those are naive because people respond to those tax cuts. Kennedy showed this in the Kennedy administration when he did a massive tax cut and revenues to the government went up. Reagan did the same thing. He cut tax rates, but revenues to the government went up. Why is that? Because on lower tax rates, people are more likely to comply with tax code. They're more likely to build a free enterprise that generates wealth. When you raise taxes to confiscatory rates, what you have very simply is a system in which people are disincentivized from abiding by the tax code and from making more money. So we need to bring that tax code back in line on dividends and on long-term thinking rather than just rewarding the short-term stock price. And we need to relook at antitrust. We need to look at these mega mergers. We need to look what they're doing for the markets and the concentration of wealth in the markets. I'm not a big government person. I'm a libertarian at heart. But I also know that maintaining a stable and an orderly marketplace is what we need in the public markets to foster the kind of development we had in the 20th century. Now, there are, again, tons of dynamics here. It's not a simple solution. And the development of the digital economy with the wealth, the true distribution that brings, it's a change that's so transformative because you're going to distribute wealth in ways that we've never thought of. That's going to change this dynamic completely. Again, DAOs and crowdfunding things and other things that really are just coming into play are going to replace some of the public market stuff. But it's all about democratizing that ownership so that average people can play in that space. To be an investor, you have to be able to buy into a company. Well, you don't want to have to buy into a private limited partnership if you don't have a lot of money because they're not liquid. So we need these liquid markets to function well. And I think we need some revival to what was. The future, if we do nothing, what you're going to see is a continued shrinkage of public companies. I wouldn't be surprised if we had 2,500 companies in the next 5 years, dominated by the mega caps. So that when you talk about the S&P 500 as a benchmark, that's not even a benchmark. It's the S&P 5. I mean, we're seeing more and more of that. I've said to people, and I'm not giving investment advice, talk to your own guys, but my personal opinion is the mega caps are going to just get bigger unless we do some of these strategic reforms. We've got to create a system in which smaller players can come into the space and enjoy the benefits of it without having, again, the risk they can't afford. You're going to see growth companies staying private. Again, this goes back Apple Computer. Instead of going public, they're going to get sold to private equity. And that's only going to benefit wealthy investors. So that concentration goes. The oligarchy will truly grow out of this regulatory state, and the consumer choices will erode and minimize because of it. It's an inevitable outcome. And political capture, what I call political capture, will deepen. Because as you have more and more concentrated wealth in private equity and these mega caps, they'll have more and more say in Washington. Now, we can only blame ourselves for it. You can't blame Elon Musk. You can't blame Tim Cook at Apple. You can't blame these people. They're trying to build their companies based on the rules they're given. It's government that sets these rules in play, government that sets these tax codes in play, and it's government that is taking away from you the opportunity to participate in the growth in America as you could under prior legislation, prior rules. So I hope that you'll understand that government is not your friend in this. They are not out for your best interest. I go back to why Bernie and AOC and those people are just hypocrites. They're out trying to gin up people saying, oh, oligarchy's bad. But they don't present any cause of that or any solution to it. The cause of it is them. The solution to it is freedom and liberty and wise tax code and tax policy. So if we do nothing, yes, there is going to become an oligarchy in America. It's not by conspiracy and tax cuts to the wealthy. It's by government trying to fix problems, but using policy that in the end of the day changes behavior. Government caused it. Number two, we have to restore the American dream. We have to favor builders over financial engineering companies. We have to favor competition over consolidation. We have to favor opportunity over oligarchy. Now, what that means, and I credit again NFIB, I'm not sucking up to them. I just really respect what they're trying to do. You have to understand, we have to get less regulatory zeal put down on the independent businesses. We have to incentivize them to go public, to sell their stock to the average person. We have to incentivize them to play in a space of a free, open market. Now, they'll figure out how to do it if we don't, but there will be a lot more concentration of wealth if we do nothing. Because a free people cannot thrive in an economy run by an oligarchy, and whether that's intentionally created or unintentionally created. And we need to have government put in policy that sets in motion a restoration of the markets that we've had. Our capital markets are the genius of the 20th century. They are the miracle of the American economy. But those capital markets allowed individual people to invest in the high growth companies of the future. Well, let's do that again. And let's get some policies that make sense for you, the people, and for the independent business. Well, I'm Steve Beaman, and thanks for just walking with me down this journey on this episode of The Steve Beaman Show. I look forward to seeing you next time.